Welcome to the deep dive.
Ah,
Ever felt like navigating the world of taxes is like trying to find your way through a dense, fog-shrouded forest?
uh-huh. Definitely feels that way sometimes.
Well, today we're cutting through that fog with a laser focus because we're taking a deep dive into Form 461, the limitation on business losses, and its incredibly detailed instructions.
Right.
Our mission: to unpack this form, understand why it exists, who it impacts, and maybe most importantly, what it means for your financial strategy. Our goal is really to transform what seems like a complicated compliance thing into, well, maybe a powerful tool for strategic tax saving, especially when it comes to leveraging those business losses.
That's right. Form 461 can certainly appear intimidating at first glance, but once we peel back the layers and really understand its mechanics, you'll see how crucial it is for non-corporate taxpayers.
Right?
It's not just about, filling out a form. It's about strategically managing how business losses are treated and carried forward, effectively turning today's challenges into tomorrow's tax benefits. We'll be looking at it step by step, focusing on those critical lines and, crucially, the tax-saving methods that emerge from mastering this form.
Okay, let's unpack this then. Before we get into the real nitty-gritty of the form itself, let's start with the big picture. Why does Form 461 even exist? Like, what problem was the IRS trying to solve here when they introduced it? And why should you, our listener, care so deeply about how business losses are handled?
That's the perfect place to begin, because understanding the why really unlocks the true strategic value of this form. You see, Form 461 isn't some ancient relic of tax law. It's actually a direct product of the Tax Cuts and Jobs Act, or TCJA.
The TCJA.
Yeah, that came into effect back in 2017. Before the TCJA, non-corporate taxpayers, so, individuals, estates, trusts, they had significantly more leeway to immediately deduct large business losses against any type of income.
Any type, like wages.
Exactly. Wages, investment income, you name it. And this could sometimes lead to situations where, well, very large business losses could essentially wipe out a taxpayer's entire income for the year, even if that income came from sources completely unrelated to the business itself. The new limitation was really designed to rein that in a bit.
Okay, so the TCJA fundamentally changed the landscape for how businesses could manage their losses. It sounds like the IRS was trying to prevent what they might have seen as an overly, maybe aggressive use of business losses to offset other income.
Precisely. The core purpose of Form 461, then, is to limit the amount of losses from trades or businesses that these non-corporate taxpayers can claim in a given year. But here's the really crucial distinction, and this is where that tax-saving opportunity lies.
Okay.
It's not about making the loss disappear entirely. It's not just gone. It's about controlling when and how that loss can be deducted. So instead of being immediately deductible in full, any excess business loss, and that's a key term we'll define in detail shortly, is treated as a net operating loss, or NOL carryover. Okay, so it's not a loss that just vanishes into thin air. It's more like a future tax credit or a banked loss you can use later on. That's a huge distinction, I think, for anyone navigating a challenging business year.
Exactly. That's the core concept. This is critical for long-term tax planning and loss utilization. Imagine your business has a tough year, right? Incurs significant losses. While you might not be able to deduct all of that loss this year because of Form 461,
Right.
understanding the NOL carryover mechanism means that valuable loss is preserved. It's not wasted. You can then use it to offset taxable income in subsequent more profitable years.
Okay.
This effectively helps smooth out your tax liability over time, making a seemingly bad year for your business still yield future tax benefits.
Can you give a quick example of how that might work?
Sure. Let's say your business generates an excess loss calculated via Form 461 of, say, $150,000 this year. Now, next year, things turn around and you project a profit of $100,000.
That $150,000 NOL carryover from the previous year can completely offset next year's $100,000 profit. Your business tax liability for that profitable year drops to zero.
Wow.
And you'd even have $50,000 of NOL left over to carry forward to the year after that. So you see, this isn't just about compliance. It's a really powerful mechanism for managing your financial future.
That makes a lot of sense.
And for anyone wanting to dig deeper into NOL carryovers specifically, I highly recommend checking out IRS Form 172. It's titled Net Operating Losses, NOLs, for Individuals, Estates, and Trusts. It's an excellent companion guide, really provides comprehensive info on how to calculate and utilize these carryovers.
Good tip. Form 172. So this Form 461 isn't just about limiting deductions, it's about facilitating a long-term tax strategy. And it sounds like this isn't some outdated rule either. You mentioned TCJA, but when exactly is this disallowance effective? Like for what tax years?
You're right. It's very current. This disallowance of excess business losses is effective for tax years beginning after 2020 and before 2029.
Okay, so right now.
Yes, exactly. So for your current tax filings and for several years to come, understanding Form 461 is absolutely essential. It's not going away anytime soon, so mastering it now will definitely serve you well.
So it's a present and, well, a future concern for business owners and others. But who exactly must file Form 461? Because I imagine it's not every single person with, a small side hustle or a part-time gig.
That's a great question, and you're absolutely right. It's not for everyone. Form 461 is specifically for non-corporate taxpayers.
Nishmis.
That includes individuals, states, and trusts. Basically, entities that are generally subject to tax under Section 511 of the Internal Revenue Code. Now, there are very specific filing thresholds that determine if you actually need to attach this form to your annual tax return.
Ah, the numbers, okay.
Yes, for the 2024 tax year, you must file Form 461 if your net losses from all your trades or businesses combined are more than $305,000.
$305,000.
Or if you are married filing jointly, that threshold doubles to $610,000.
$610,000 for joint filers.
Got it. So those are pretty substantial thresholds. It sounds like this form is really targeting significant business losses from maybe larger scale operations or multiple ventures.
They certainly are substantial. However, there's also an important catch-all rule that brings in certain taxpayers even if their aggregate losses don't quite hit those higher thresholds.
Ooh, what's that?
You must also file Form 461 if you would report a loss of more than $152,500 on any one of Form 461, lines 1 through 8.
It's just one line, even if the total isn't over $305K.
Exactly. We'll explain what those lines cover when we walk through the form in a bit. But this ensures that even a significant loss from a single specific business activity, even if your other business activities are profitable or just break even, could trigger the filing requirement. The IRS wants to capture these larger individual business losses that contribute to the overall picture, you see.
That makes sense. It closes a potential loophole. Right. And once you determine you need to file it, Form 461 must be attached to your applicable tax return. This includes a pretty broad range of returns. Most commonly, Form 1040 for individuals, but also Form 1040 SR for seniors, Form 1040 NR for non-resident aliens,
Okay.
Form 1041 for estates and trusts, Form 1041 QFT for qualified funeral trusts, Form 1041N for electing Alaska Native Settlement Trusts, and for trusts only, Form 990T, the exempt organization business income tax return. So yeah, it tests a pretty wide net across different non-corporate structures.
It definitely sounds like it. Okay, that makes perfect sense. It's about ensuring that significant losses, whether from one business or many, are appropriately accounted for under these rules. Now, before we start breaking down the form line by line, which I know everyone's eager for, there are some absolutely critical terms we need to understand. If we connect this back to the bigger picture, these definitions seem like the bedrock for accurately filling out the form and, ultimately, for understanding how you can truly maximize those future tax savings. What's fascinating here is how precise the IRS gets with its language, right? And why knowing these definitions is so critical for accurate reporting.
Absolutely. You hit the nail on the head. Misunderstanding these core definitions can easily lead to errors. And those errors not only cause compliance issues, headaches with the IRS, but they can also prevent you from fully realizing the tax benefits of your losses in future years. It undermines the whole strategy.
Right. So let's start with the big one you mentioned earlier, excess business loss. What exactly does that mean in IRS terms?
Okay, excess business loss. This is the amount by which your total deductions from all your trades or businesses exceed your total gross income or gains from those same trades or businesses, plus that specific threshold amount we just talked about.
The $305K or $610 for 2024.
Exactly. So think of it as the portion of your total business loss that goes beyond what the IRS allows you to deduct in the current year. It's the part that gets excess.
So it's the portion of the loss that gets banked for later as an NOL.
Got it. And are there any specific types of deductions that are excluded when we're calculating this total deductions from trades or businesses? That seems important.
Great question. Yes, there are crucial exclusions. It simplifies the calculation and prevents any double counting. When you're figuring out your total deductions for this specific purpose on Form 461, you do not include any deduction allowed under Section 172.
Which is the NOL deduction itself.
Right, that would be circular. And you also don't include the deduction under Section 199A, which is the Qualified Business Income Deduction, or QBI.
Okay, QBI is out too.
Yeah, these are separated out to ensure the calculation for Form 461 is clean and accurate, focusing solely on the operational losses of your actual business activities. And there's another critical exclusion.
You must also disregard any deductions, gross income, or gains attributable to any trade or business of performing services as an employee.
So W-2 stuff is completely separate.
Completely separate. This limitation specifically targets non-corporate business losses, things like entrepreneurial activities, investments that qualify as a business, not your regular salary income, and associated expenses from being an employee.
That's a very clear distinction.
Yeah.
Helpful. So this form isn't about your W-2 job. It's for those with an ownership stake in a business, essentially. And you mentioned that threshold amount. Again, can you just recap that for 2024?
Sure. The threshold amount is your baseline. It's the maximum amount of net business loss you're allowed to deduct in the current year before the excess business loss rules kick in and convert the remainder into that NOL carryover. For 2024, it's $305,000 for most individual filers.
Right.
And if you are married filing jointly, that amount doubles to $610,000.
$610K joint. Got it.
And it's worth noting, these amounts are indexed for inflation, so they adjust slightly each year to account for changes in the cost of living, keeping them relevant over time. Always best to check the most current figures from the IRS instructions for the specific year you're filing.
That indexation is helpful. It keeps the thresholds from becoming outdated. Now, another term that seems absolutely fundamental is trade or business. How does the IRS define what activities actually qualify under Form 461? This definition seems crucial because it determines what gains and losses even get considered in the first place.
You've hit on perhaps the most fundamental definition for this whole form. Determining what qualifies as a trade or business is absolutely essential as it dictates the entire scope of Form 461. Basically, an activity qualifies if your primary purpose for engaging in it is for income or profit.
Primary purpose, profit. Okay.
And importantly, you must be involved in the activity with continuity and regularity. It's not just about having a hobby that occasionally sells something online or making a single sporadic investment.
Right.
It needs to be consistent. Exactly. The facts and circumstances of each specific case are paramount. This means the IRS looks at the overall picture. Are your activities regular? Are your transactions continuous? Are they genuinely aimed at the production of income, even if you don't actually make a profit every single year? You don't necessarily need to be profitable year after year.
Which is good news for startups, maybe.
Right. But you do need to demonstrate a clear and genuine profit motive and show ongoing, consistent efforts to further the interests of your business. Think about it. A hobby might make some money occasionally, but a real business consistently tries to grow, market itself, manage expenses, operate like a business, even in leaner years.
That continuity and regularity seems like the key differentiator then. It helps distinguish a legitimate business venture from just a casual pursuit or a hobby. What about situations where you have an interest in, say, a partnership or an S corporation? How does the trade or business definition apply there? Does it depend on my involvement?
That's a very important distinction for many taxpayers, especially with pass-through entities. If you own an interest in a partnership or an S corporation, the trade or business determination is actually made at that entity's level, not your individual level.
So at the partnership level itself.
Correct. This means the partnership or the S corporation itself must be engaged in a trade or business for your share of its income or losses to be potentially subject to the Form 461 rules. Your individual level of involvement then comes into play with other limitations like the at-risk rules or the passive activity rules, which we can touch on later. Those look more at your personal participation.
Okay, that's clearer. The business itself has to be a business first. Now, this is where it gets really interesting, I think. Those capital asset rules, they can often feel like a trap for the unwary. How are capital gains and losses treated under these definitions, specifically for Form 461 purposes? Because they can be a huge part of someone's financial picture, and it sounds easy to get this wrong.
You're absolutely right. This is a subtle but truly vital point that significantly impacts how amounts get entered on the form. Let's break it down carefully. First, when it comes to losses from the sale or exchange of capital assets.
Okay, capital losses.
These are not included in the calculation of your total deductions from trades or businesses for Form 461 purposes. This is a very specific exclusion.
So wait, even if I sell a capital asset at a loss, and it was related to my business, maybe like a piece of equipment or property I held for investment within the business, that capital loss doesn't factor into the Form 461 calculation.
That's correct. That specific capital loss doesn't get counted in the deductions that might trigger an excess business loss on Form 461. This prevents those specific capital losses from being limited under this particular rule. They are handled by the separate general capital loss rules in the tax code.
Okay, that's a huge clarification. So business-related capital losses don't add to the potential excess business loss. What about capital gains? Are they fully included then to offset other business losses?
For gains from the sale or exchange of capital assets, it's equally precise and maybe even more nuanced. These gains, when included for Form 461, should not exceed the lesser of two amounts.
Uh-oh, lesser of two. Okay, what are they?
The first amount is capital gain net income limited to only gains and losses attributable to a trade or business. The second amount is your overall capital gain net income.
Okay. That's a bit dense. Can you maybe give us a quick example to make that lesser of two rule clearer in practice?
Certainly. Let's try an example. Imagine you have $10,000 in capital gains from selling some old business equipment that's clearly business attributable.
Okay, $10 business capital gain.
But let's say you also have $20,000 in capital gains from selling some personal stock investments completely unrelated to your business.
20K personal capital gain. Got it.
So your overall capital gain net income for the year is $30,000, $10K plus $20K. Now, for Form 461 purposes, the IRS will only allow you to consider the business-related capital gains, which is the $10,000 from the equipment sale. Why? Because that $10,000 is the lesser of the two amounts. It's less than your total overall capital gain of $30,000.
Ah, I see. So it stops you from using those non-business capital gains, like from personal stocks, to artificially reduce your potential business losses for the Form 461 calculation.
Exactly. It's all about ensuring that the components that feed into Form 461 are genuinely related to your active trade or business activities. It ensures consistency and prevents, well, unintended tax benefits from mixing personal and business capital gains in this specific context.
Wow, that is a lot of precision, but incredibly important to get right. Okay, so now that we have our key terms, straight excess business loss, threshold amount, trade or business, and those tricky capital gain loss rules, let's get into the nitty-gritty.
Right.
How do we actually fill out this form line by line? This is the item-by-item breakdown you've been looking for. But let's focus on the purpose of each section and maybe highlight the lines that often trip people up or offer important strategic insights. All right, let's do it. Let's stop treating this form like some kind of secret code and start deciphering it section by section. We'll navigate through the key areas, focusing on why certain information is requested and what common pitfalls to avoid. This meticulous, focused approach is absolutely key to accurate reporting and, maybe more importantly, to correctly calculating any excess business loss that can be carried forward as that valuable NOL for future tax savings. Okay, we begin with Part I total income loss items. The purpose of this section is essentially a data dump initially, just gathering everything up.
Pretty much. It gathers all income and losses reported on your main tax return that might be relevant to the calculation, whether they're directly business-related or not at first glance. We'll refine these amounts later in Part 2. Most of these lines are fairly straightforward, really just pulling numbers directly from other familiar schedules you've likely already filled out.
Yeah.
Line 1 is simple. It's reserved for future use. Just leave it blank. No tricks there.
Easy start.
For line 2, you'll enter any business income or loss from Schedule 1, Form 1040, line 3, or the equivalent line on Form 1041, which is also line 3. For many of our listeners, this is where their sole proprietorship income or losses, typically coming from a Schedule C, will appear. So if you're running a small consulting firm or maybe a freelance business, this is a key entry point.
Schedule C income loss goes on line 2.
Got it. Now, line 3 is for capital gains or losses. This comes from Form 1040 or 1040-SR, line 7, or other equivalent forms for estates and trusts. And this is exactly where those nuanced capital gain and loss rules we just spent time discussing become critically important.
Right, the ones we just defined.
Exactly. Remember our definition. Losses from sales or exchanges of capital assets are not included in the total business deductions for Form 461. So if you entered such a loss here on line 3,
Which might just be the total from your Schedule D.
right, If that total includes capital losses, you must remember to add that loss amount back as a positive figure later on line 11 in Part 2. This removes it from this form's specific computation.
Okay, add back capital losses on line 11.
Similarly, any capital gains that are not directly attributable to your trade or business, but are included here on line 3, like those gains from selling personal stock in our example, should be added back on line 10 in Part 2 to remove them from the calculation as well.
Add back non-business capital gains on line 10. Got it.
It really highlights the absolute importance of distinguishing business versus non-business capital gains and losses when you're looking specifically at Form 461. You can't just copy numbers blindly.
That's a crucial instruction right there. If you just blindly carry over your totals from Schedule D without remembering those specific exclusions and adjustments needed for Form 461, you could easily miscategorize them and significantly mess up your overall business loss calculation.
Exactly right. Accuracy here is paramount. It really affects the outcome. Moving on, line 4 is where you enter any other gains or losses reported on Schedule 1, Form 1040, line 4. This might include things like income or loss from selling business property that isn't technically a capital asset, like maybe certain types of equipment under Section 1231.
Okay, other gains losses on line 4.
Then line 5 is pretty significant for anyone with interests in pass-through entities. Here, you'll enter any supplemental income or loss reported on a Schedule E.
Schedule E, so rentals, partnerships, S-Corp.
Precisely. This is crucial for people with income or losses from rental real estate, royalties, partnerships, S-corporations, estates, trusts, or even ceramics. If you're a partner in a business or an S-corporation shareholder, your share of that entity's income or loss would generally flow through Schedule E and be reported here. So it's a vital component for many business owners.
Makes sense. Line 5 captures pass-throughs.
Line 6 is specific to farming businesses. You'll enter any farm income or loss from Schedule 1, Form 1040, line 6, usually coming from Schedule F. Farmers have some unique considerations, as we'll discuss, and this line helps capture their business-specific income and loss figures.
Line 6 for farms.
Line 7 is another one reserved for future use, so you can just leave that one blank as well.
Good.
Then for line 8, this is a bit of a catch-all. You enter any other trade or business income, gain, or loss not reported on lines 1 through 7 that you still reported somewhere on your main tax return. It's designed to ensure that all relevant business income and losses are captured, even if they don't fit neatly into one of the prior categories.
A safety net line, basically.
Kind of, yeah. Finally, line 9 simply combines all the entries from lines 1 through 8. Add them all up. This is your total preliminary income or loss figure before any adjustments. It can be a positive number if you have overall income from these activities, or it could be a negative number if you have a net loss across all these categories combined. This is your raw snapshot before we start filtering in Part 2.
Okay, so Part 1 is done. We've gathered all the raw data. Now, as promised, Part 2 adjustment for amounts not attributable to trade or business. What's the real goal of Part 2? What are we trying to achieve by making these specific adjustments here?
The goal of Part 2 is refinement, precision. We're taking that broad snapshot from Part 1 and filtering it down. Its core purpose is to specifically remove any income, gains, losses, or deductions that are not from a qualifying trade or business, as we defined it earlier.
Getting rid of the non-business stuff.
Exactly. This is absolutely critical because the limitation on business losses, the whole point of Form 461, only applies to actual business activities, not your personal investments or other non-business income or losses. This ensures only truly business-related amounts are considered for the limitation calculation, which makes your eventual tax-saving strategy both precise and compliant.
Okay, so how do we do that? Line 10.
Right. On line 10, you enter the combined amount of income or gain that you reported back on lines 1 through 8 in Part I that is not from a trade or business. So, for example, if on line 3 you reported that significant capital gain from the sale of your personal stock, which isn't business-related.
Like in our example earlier.
Precisely. This is where you would enter that amount to effectively back it out of the calculation. We're isolating just the business income here.
Makes sense. Subtract the non-business income. What about line 11?
Line 11 is equally important, maybe even more so, and requires very careful attention to detail. Here, you enter the combined amount of losses or deductions that you reported on lines 1 through 8 in Part I that are also not from a trade or business, and this is a crucial instruction.
Okay, I understand.
Although losses and deductions are usually entered as negative figures, or in parentheses elsewhere on tax forms, on this specific line, line 11, you must enter them as a positive figure.
As a positive number, even though it's a loss or a deduction.
Yes. It's a procedural detail on the form itself. Entering it as a positive here ensures it subtracts correctly in the next step, line 12. It prevents miscalculation.
Okay, that's definitely the kind of procedural nuance that often trips people up. It's so easy to overlook something like that, and it can completely throw off your calculation if you're not paying super close attention to the enter as a positive figure instruction.
Absolutely. It's a common spot for errors. And just to reiterate a key point from our definitions related to this, if any losses from sales or exchanges of capital assets were included back on line 3 in part 1,
Right, those capital losses.
they should be added back here on line 11 as a positive amount. This effectively removes them from the calculation of your total trade or business deductions for Form 461 purposes, ensuring those specific capital losses aren't mistakenly subjected to this business loss limitation.
Got it. Capital losses added back positive on line 11 too.
Then, on line 12, it's simple math. You just subtract line 11 from line 10. The resulting figure is your net gain or loss that is not from a trade or business. This amount is then used in the next part, part 3, to accurately refine the overall loss calculation, ensuring that only your true net business losses are actually subjected to the limitation threshold.
Okay, so part 1 gathers everything. Part 2 weeds out all the non-business stuff. And now we finally move into part 3, limitation on losses. This feels like where the rubber meets the road, right? This is where the actual limitation gets applied, and that all-important excess business loss is finally calculated.
That's precisely right. This is the culmination. It's where all the previous calculations come together and where we determine if you have an excess business loss, and if so, exactly how much gets carried over for those potential future tax savings.
All right, let's break down part 3, line 13.
Okay, line 13. This line is a little bit counterintuitive, so follow closely here. It's essentially a mathematical maneuver designed to ensure that when we combine it with your initial figures from part 1, we are left with a clean representation of only your net business income or loss, ready to be directly compared against the threshold amount.
How does it work?
If line 12, remember that was your net non-business gain or loss from part 2, if that number is negative, you enter it here on line 13 as a positive number.
Flip the sign if it's negative on line 12.
Correct. Conversely, if line 12 is a positive number, you enter it here on line 13 as a negative number.
Flip the sign if it's positive too.
Yep.
Okay, so you always flip the sign from line 12 to line 13.
You got it. Think of it like adjusting a scale to zero out the weight of the container before you measure the actual contents. We're zeroing out the non-business impact.
Clever analogy. Okay, what's next? Line 14.
For line 14, you simply add line 9, that was your initial combined income loss from all sources in part 1, and line 13, the adjusted sign-flipped non-business amount. This resulting figure on line 14 can be positive or negative. It now represents your refined net total income or loss arising only from your business activities after we've meticulously removed all those non-business components.
So line 14 is the pure business result.
Exactly. Now, on line 15, you enter the specific threshold amount for the tax year. For 2024, that's $305,000 for most individual filers, or $610,000 if you are married filing jointly. This is your allowed loss limit for the current year, the point where the limitation might kick in.
The $305K or $610 goes on line 15. Check.
And then we come to the moment of truth. Line 16. This is where the actual excess business loss is calculated. You simply add line 14, your net business income loss, and line 15, the threshold amount.
Add them together.
Okay. Now, the instruction here is very specific. If the result on line 16 is less than 0, meaning if it's a negative number, then this negative amount is your excess business loss.
Okay, so if line 14 plus line 15 is negative, that negative number represents the loss amount that's over the limit. That's the part that gets carried forward.
Precisely. That negative figure represents the portion of your business loss that you cannot deduct this year.
So if that number on line 16 is negative, you've definitely hit the limitation. But how do you actually report this excess business loss adjustment on your main tax return, like the 1040? Is it entered as a negative number there too?
Another crucial procedural point. This trips people up too. Even though it represents a loss that's being limited, you actually report this excess business loss adjustment as a positive number on the other income line of your primary tax return.
As a positive number. Why?
Because adding it as positive other income effectively increases your taxable income on the main form. This reflects the fact that you're disallowing that excess business loss deduction for the current year. It cancels out the excess part of the loss you initially claimed elsewhere.
Okay. So the positive entry on the 1040 cancels out the excess loss deduction taken earlier. Makes sense mathematically. Where exactly does it go?
For Schedule 1, Form 1040, for example, you'd enter this positive amount on line 8P, which is labeled Other Income, and you must also enter the letters ELA, which stands for Excess Loss Adjustment, on the dotted line next to the amount.
ELA, got it.
Yes. This notation tells the IRS exactly what that positive income adjustment represents. Similar other income lines exist for the other applicable tax returns we mentioned: Form 1041, line 8, Form 1041 QFT, Part 2, line 4, Form 1041N, Part 2, line 4, and for trusts using Form 990T, it goes on Schedule A, Part 1, line 12. This is how the IRS officially records that you have an excess business loss that will be carried forward as an NOL.
That's a lot of numbers and lines, but walking through it like that makes it much clearer. So, okay, we've figured out the excess business loss. What does this all mean for you, the listener? You've done the math, you've got an excess business loss. Now what? How does this connect back to the bigger picture of managing your overall tax liability and, dare I say, implementing truly smart tax-saving methods for the long haul?
Right. This is where the practical outcome and the significant benefit of understanding this whole limitation process truly come into play. The most important implication, and really the core tax-saving mechanism built right into the Form 461 rules, is that an excess business loss is not lost forever. It's not just gone.
That's the key point.
It's the key point. It's treated as a net operating loss, or NOL carryover. This means you can use it to offset taxable income in subsequent taxable years. Think of it as a valuable tax asset that you couldn't fully use this year, but you get to bank it, essentially, for future, more profitable years. It's a strategic way for the tax system to acknowledge your loss, but manage its immediate impact on government revenue, while still preserving its value for your long-term financial health.
So it's really about shifting the timing of the tax benefit, not eliminating it entirely. That's a huge distinction for anyone trying to manage the inevitable ups and downs of running a business. Sounds like even a really bad year can still have a silver lining for future tax bills.
Exactly right. And because you're carrying it forward, the absolute necessity of keeping detailed, meticulous records of your excess business loss calculation from each tax year cannot be overstated.
Good record keeping is crucial.
It's vital for accurately tracking these NOL amounts and ensuring you can fully utilize them in future years when your business is more profitable. Imagine this scenario again. You have that excess business loss of $200,000 this year. Next year, your business makes a solid profit of $150,000. That NOL carryover can fully offset that profit, bringing your taxable business income down to zero for that year.
Nice.
And you'd still have $50,000 of NOL left to carry forward to the following year. Without accurate records from the year the loss occurred, identifying and utilizing these banked losses becomes incredibly difficult, maybe impossible. You might just forget about them.
Losing out on significant future savings.
Exactly. And again, for the comprehensive rules on NOL carryovers, how long you can carry them, how to report them on future tax year returns, Form 172 is really your go-to guide from the IRS.
Form 172 again. Okay. Now, it's also important to understand where Form 461 fits within the broader ecosystem of tax loss limitations.
Yeah.
Like you mentioned earlier, it isn't the first or only limitation. There's a specific order, a hierarchy.
Yes, that's correct. There's a specific hierarchy or ordering rules that you must follow. This ensures that the correct amount of loss is subject to each limitation in the proper sequence, and it prevents any double counting or misapplication of the rules. Think of it like a series of filters that your initial business loss must pass through.
Okay, like a waterfall of limitations.
Yeah.
You hit one, then potentially the next, then finally Form 461. Can you walk us through that specific order? What comes first?
Absolutely. This is crucial for accurate planning, especially if you have complex situations. First, before you even get to Form 461, you apply the at-risk rules. These are typically figured out on Form 6198.
At-risk rules, Form 6198. What do they do?
Essentially, these rules limit your deductible losses to the amount you have personally invested in the business or are personally liable for the amount you actually stand to lose economically. They prevent you from deducting losses that exceed your actual financial skin in the game. For example, if you invested $50,000 cash in a business, but it generated a $70,000 loss, the at-risk rules might initially limit your deductible loss to just $50,000, the amount you had at risk. The other $20K is suspended.
Okay, so first check. How much do I actually have at risk?
Right. Next, after applying the at-risk rules, you apply the passive activity loss rules, often called the PL rules. These are quite complex and are covered in detail in IRS Publication 925.
Passive activity loss rules, Pub 925. The gist.
In essence, they generally prevent you from deducting losses from passive activities, things like rental properties where you don't materially participate, or businesses you invest in but don't actively run against non-passive income, like your wages or income from a business you do actively run.
So can't use rental losses against my salary, usually.
Generally, no. Any losses disallowed by these PL rules are suspended and carried forward until you either have passive income to offset them against, or you dispose of the entire passive activity itself.
Okay, so filter 2 is passive activity rules. Then what?
Then, and only then, after those first two limitations, the at-risk rules and the passive activity loss rules have been applied and potentially reduced or suspended your loss, then you apply the excess business loss rules using Form 461. The amount of loss that makes it through both the at-risk and passive activity filters is the amount that finally gets tested against the Form 461 threshold, $305 or $610.
Wow. So the loss figure hitting Form 461 might already be reduced by other rules.
It very well could be. The sequencing is vital for ensuring consistency and preventing taxpayers from, say, circumventing one limitation by applying another one out of order. It provides a logical flow.
That provides really crucial context,
Right.
especially for anyone with multiple types of income streams or more complex business structures. It's a very systematic approach the IRS takes. Are there any other specific rules for certain types of businesses, maybe like farming, that we should be aware of when it comes to Form 461 interacting with other rules?
Yes, farming businesses do have some specific considerations, mainly because they have historically had unique tax provisions related to losses. Taxpayers with losses from a farming business must apply the excess business loss limitation using Form 461 before they can utilize a special rule that sometimes allows farming NOLs to be carried back 2 years.
Ah, so Form 461 comes before the carryback for farmers.
Correct. Generally, most NOLs now are only carry forward, but this specific interaction applies if that farming carryback is still relevant. Furthermore, if you happen to incur both farming business losses and non-farming business losses in the same year, and the total exceeds the Form 461 threshold amount, you must allocate that threshold amount, $305K, $610K, first to the farming losses, up to the amount of your NOL that's attributable to farming. It's a targeted rule to ensure the proper treatment of farming losses, kind of acknowledging their unique economic cycles. For more granular detail on this, Publication 225, The Farmer's Tax Guide, is really the invaluable resource for agricultural businesses.
Good to know. Pub 225 for farmers. What about some administrative points, like joint returns or amended returns?
All right, good points. A quick but important reminder on joint returns. If you're married filing jointly, you only complete one Form 461. This single form should encompass all the relevant business loss information for both spouses, consolidating the figures, which simplifies the process somewhat.
One form per couple.
Got it.
Amended returns.
Yes. If you find you need to amend a prior year's tax return, maybe you found an error or received new information and Form 461 was applicable in that original year, or perhaps it becomes applicable because of the changes you're making. You must recalculate and attach the corrected Form 461 to that amended return, Form 1040X or equivalent. This ensures consistency and proper recalculation if your original loss figures change, preventing discrepancies with the IRS down the line.
Always update Form 461 if you amend. Makes sense. Anything else? Maybe about losses limited in prior years?
Yes, the transition rules, though maybe less common now, are worth mentioning. If you had losses or deductions that were limited under other Internal Revenue Code provisions in tax years before the excess business loss rules fully kicked in, say, losses suspended under the at-risk rules or passive activity loss rules from years ago.
Okay.
Those previously limited suspended losses or deductions are still included when figuring your current year's potential excess business loss on Form 461 once they become deductible under their original limiting rules. This prevents those prior limitations from somehow allowing you to circumvent the current year's Form 461 calculation. It ensures a comprehensive look at all business losses becoming available in the current year.
That seems fair. Captures everything eventually. Okay, this has been incredibly comprehensive. So this form, while it definitely seems complex on the surface, is really designed to be very specific about what constitutes an excess business loss, and crucially, how that excess amount is then preserved for future use. Which brings us back to the big question. What's the practical takeaway for our listener? How does understanding this intricate process help them beyond just, filling out another government form, especially when it comes to long-term financial strategy and finding those potential tax savings?
Yeah, that's the most important part, really. What's fascinating here, and I think the core message, is that Form 461 isn't fundamentally a punitive measure designed to simply take away your business losses permanently. It's not trying to punish you for having a bad year.
That's a relief to hear.
Right. Instead, it's more of a structural mechanism the IRS uses to manage how large business losses are recognized and utilized within the broader tax system, especially considering their potential impact on overall tax revenue in a given year. The key takeaway, and this is where the tax saving methods become crystal clear, is that these excess losses aren't permanently disallowed. They are converted into those valuable net operating loss carryovers.
The NOL carryover, that's the prize.
That's the price. It means that a seemingly bad year for your business, one where you experience significant losses that exceed the threshold, can still provide a substantial tax benefit in the future if you manage it correctly. By meticulously calculating the excess loss using Form 461 and then carefully tracking these NOL carryover metrics.
With good records.
With good records, you are essentially creating a future tax asset. This knowledge empowers you to plan for future profitability, knowing you have these banked losses ready to offset that future income, thus strategically reducing your taxable income and your tax bill in subsequent better years. It's really about strategic deferral and long-term optimization of your tax liability, rather than just accepting a large loss as a completely lost opportunity in the current year.
So the mantra should be deferral and strategic utilization, not outright denial. That changes the perspective on Form 461 entirely. This deep dive really highlights the incredible importance of understanding every line, every definition, and every instruction, because that's where the opportunities, even in challenging times for your business, can truly be found. It's a testament really to how even seemingly obscure or complex tax forms can reveal powerful ways to manage your financial landscape effectively.
Well said. It's about turning compliance into strategy.
Exactly. So for you, the curious learner listening today, consider this. If a complex form like 461 holds such crucial implications for managing business losses over time, essentially transforming a current challenge into a future financial advantage, what other seemingly niche tax revisions or maybe lesser-known IRS forms might contain unexpected avenues for financial planning or strategic long-term benefits that you haven't yet explored? The world tax forms is certainly vast, but as we saw today, with a deep dive, clarity, and potentially powerful opportunities for smart financial management can definitely be found.